Sam, so nice for you to come over here and meet us and hanging out with us. We're all big fans over here.
Well, thanks for having me.
Well, it's been a real pleasure. Ever since you guys came up in this space, caught a lot of people by surprise, to be honest. Like, we just started seeing you guys pop up on the BitMEX leaderboard, then having another account popping up, and we were all like, who are these guys? So, for the folks that are listening in and don't really yet know, just who is Alameda Research?
Yeah. And I think you're not alone in sort of not sort of seeing us come out of nowhere to some extent. And a lot of the reason for that was, for a while we basically just didn't see a compelling reason to be very public. Uh, so we're a quantitative trading firm in cryptocurrency. I was at Jane Street Capital before this, trading international ETFs. I left late 2017 and started up Alameda. And we sort of do a combination of quantitative trading, arbitrage, liquidity providing, and OTC trading in crypto. And yeah, for the first year or so, we were pretty much just hiding under a rock. We had contacts with basically no one in crypto other than exchanges, and so all of the exchanges sort of knew who we were because we're one of their highest volume traders. But outside of that, we had no public presence. We had no customers, and we're just sort of holed up in an office.
When did you guys decide to start being more public about who you guys were?
So I think, sometime mid to late 2018, we launched an OTC trading desk. And that was sort of the first time that we saw a real advantage in it. And so that's at AlamidaOTC.com. And basically what it is, it's a place where you can get 24/7 electronic OTC quotes. So if you want to, buy 100 Bitcoins, you can just type that in. It'll give you a quote and you can trade with it there if you want. And as we were rolling that out and promoting it, it quickly became clear that it was going to be really hard to do that if we didn't have any actual connections in crypto. If no one who knew who we were, the only people who were able to trade with other being were the exchanges because they're the only ones who actually knew us. And so late 2018 we started to increase our profile. And sort of the first step of that was I went to a bunch of conferences, starting with Sora Summit in Macau, then going to Beyond Blocks, Block Show, and a few others.
So, from what I'm understanding, after you came from Jane Street, a lot of the trading you guys wanted to do was around arbing, right? But what type of challenges and awkward realities did you guys crashed into when you just started trading based on and trying to make arb strategies between different exchanges, assets, and even just jurisdictions?
Yeah, it's a super interesting question. And for some context, if you're trading Apple stock on the New York Stock Exchange and NASDAQ, the hard part is finding an arbitrage ever existing. And if you can do that, you're done. If you buy Apple on NYSE, you sell it on NASDAQ, you make a penny on that, you're done. You just made a penny. But there's almost never an arbitrage opportunity. And sort of crypto is the opposite of that. There's, especially late 2017, there are arbs all over the place. But that was sort of just one piece of the puzzle. And to give some sense of what problems you run into, you know, in order to actually finish an arbitrage, you need to cycle the assets around, right? Because a Bitcoin on Coinbase and a Bitcoin on Bitstamp aren't even the same thing. You can't sell your Coinbase Bitcoin on Bitstamp. You first need to move it over. And all right, that's not that hard. But let's say you need to move dollars between the exchanges. Well, now you need a bank account that's willing to process a wire transfer from a cryptocurrency exchange. And actually, a lot of banks just are not willing to do that. All right, now let's say that you realize that actually some of these exchanges only process withdrawals once a day. And they have a withdrawal limit of $10,000 a day, and you just did a $1 million arbitrage. And now you're like, oh shit, it's going to be 10 days before I can get this capital out, And so just, I'm stuck with this, with these Bitcoins just sitting there. And you can't short sell also. So maybe you want to buy on Coinbase and sell on Bitstamp, but if you don't currently have a Bitcoin on Bitstamp, sure, you can buy the Bitcoin on Coinbase, but then you have to send it to Bitstamp. That's going to take, half an hour, something like that. And maybe the arbitrage is gone by the time it gets there. Maybe you're trying to do an arbitrage between a US and a Japanese exchange, and you realize that you need a Japanese bank account to get money out of a Japanese exchange. You need a Japanese resident to get a Japanese bank account, and you need a Japanese entity, and you need to do currency conversions, and they only process once a day. And you start piling on thing after thing here, and quickly it becomes clear that 80% of the challenge of successfully doing arbitrage in crypto often is all the operational steps necessary and understanding exactly what is a tether on HitBTC and how is that different from a tether on Binance.
Now, I imagine there's also the added challenge that a lot of the volume that shows up on these exchanges are simply just fake. Like, you think there's a BTC order, or a nice bid, or a nice ask, but once you just touch it or grace it, it completely disappears. Like, how could you plan around this? Did you study the real volume in the market, the real
Yeah.
liquidity?
So we did, and we actually wrote a report on this. You can find it if you go to ftx.com, and then you can click on volume monitor on sort of the left-hand tab, and sort of see our our monitor of like global real volume by exchange, and it's quite a bit different from CoinMarketCap because, as you say, most volume is fake. We think something like 3/4 of reported volume is fake, and what we found is that order books are often real. The thing that's often fake is reported volume that prints. And so, um, if you actually see what looks like a tight liquid market, by and large, those are real. The thing that you see instead often is an exchange claiming to trade $1 billion a day, and then you pull up the order book, and it's a Bitcoin USDT order book, which is 2% wide with 0.1 Bitcoins on the bid and offer, and you're like, no fucking way. Like, there's no way that market trades $1 billion. And then you look at all the prints, and every 2 seconds, a print for 1 Bitcoin goes up at the mid price, which is not even a possible legal price to print something at. So, often what happens is they'll have illiquid but real order books, which are straightforwardly useless, and then they'll just make up fake volume, and print trades that never happened in order to try and climb to the top of CoinMarketCap.
How long did it take you guys to study what the actual liquidity of the exchanges was?
It was a really ongoing process, mostly just given the number of exchanges. There are 100 exchanges, and you have to individually sort of look into each one. But eventually we decided to automate this, and that made it a lot quicker. And we came up with a few tests that actually just do a pretty good job. And just this single test actually does like 50% of the work for you, which is look if all of the trades that print either on the bid or on the offer, because that should be the case, right? If you're going to trade, you have to either be lifting the offer or hitting the bid. You can't trades can't print at mid. And it turns out that you can get rid of most fake volume if you just exclude exchanges where a large number of their trades are happening at a price which is neither what the best bid was right before the trade nor the best offer.
I imagine there's an added challenge to this because right now, well, it's been the case for a while. Most of the actual trading happens in Asia, right? But a lot of the fake exchanges and fake volume also are Asian. So, what challenge did you have with this?
Yeah, I think this is, above everything else, sort of a perceptional problem. There's this general perception that Asian exchanges have a lot of fake volume, and it's true. Most Asian volume is fake, and most fake volume is Asian. But as you point out, it's also true that most real volume is Asian. And so what that meant, I think, is that a lot of people ended up with a pretty big misconception about this, where people felt like, like all those Asian exchanges are fake. I looked at 10 and they're all fake. And they're correct. They did look at 10, and those 10 were all fake. But even if you get rid of all those fake ones, what you're left with is still most of the volume being in Asia. And so what this means is that you actually can't use as a heuristic anything about the jurisdiction of the exchange in order to determine whether it's real or fake. The 2 highest volume exchanges in the world are OKEx and Huobi. And naively, it's actually not very it's not very easy to distinguish those just looking at the website from 50 copycat Chinese exchanges that popped up.
Also, a lot of those Asian exchanges have their direct access to the miners and the new bitcoins that come into the liquidity.
Yeah, that's right. And you do see a lot of basically fake exchanges started by real people with real connections in crypto who decided that basically, it's just like exchange was not their core business. They, as you said, they had, they had like a mining firm or something like that. They decided to start an exchange and they decided to kickstart their exchange, so to speak, by printing a bunch of fake volume. And they never got any real volume. So it's not like that was, just sort of the, appetizer and the main course was a liquid exchange. It never grew out of the fake phase. But yeah, as you said, you can't even look at whether the team is legit sometimes because sometimes legit teams will fake volume as well.
Now, I have a question regarding all the arbitrage you do. One of the key factors in your strategy, I imagine, is the stability of the actual USD, right? So the stable coins themselves give you a nice value as to how to even start these tradings. Now, could the Alameda trading strategies even work without the existence of stable coins, considering just how slow the movement of coins across exchanges is?
Yeah, it's a good question, and the answer is sort of, but it would knock out a lot of volume. Most spot volume nowadays is happening against stable coins. And it's just so much easier, right? Like if you want to have an exchange with banking, the exchange needs to have a bank account. Each customer needs to have a bank account. And all of the relevant bank accounts have to be comfortable with crypto. And anyone who's tried to bank in crypto knows that's not easy. We've had 10 banks close down our accounts just because we did crypto. And it's always the same thing. We'd have a great experience for a month. And then at the end of the month, the compliance department would look over kind of that branch and say, hey, it looks like 80% of your wire transfer volume was Alameda Research. What's up with that? And the local bank tellers would be like, oh yeah, no, those are the schools. They're like, those 25-year-old kids. They're doing this like global cryptocurrency trading business. We got all these like wire transfers and lots of currencies between lots of businesses doing Bitcoin stuff across the world. And clients would be like, that's literally the worst customer you could describe. Like,
Oh, I
how
imagine
how
the
could you even
compliance.
think about, right? Like as a bank trying to AML KYC these funds, and you're like, all right, well, who did you buy the Bitcoin from? I don't know. We bought it on an exchange. We don't know who the counterparty is. Well, okay, did the exchange know? Nah, the exchange doesn't do KYC. And you sort of like chase down this rabbit hole, and it's a nightmare for banks. Um, and so stablecoins really make this a hell of a lot easier to do. However, even stablecoins can be interesting because a lot of stablecoins are not perfectly stable. And in the end, what this traces down to is can you create and redeem them for $1? If you have a stablecoin and you can always instantly send it to an address and get $1 wired to you and send $1 to a bank account and get a stablecoin sent to your address, then it's going to trade at basically $1 because there's just an easy arbitrage. But if you charge a percent to create or redeem it, if it takes a week to do a creation redemption, if you just don't allow redemptions, then all of a sudden what you have is this thing you say it's $1, but it's sort of only mostly $1.
One of the famous examples I remember was when we had the huge Korean premium.
Yeah, no, that's
Did you play in
absolutely
that?
right. Yeah, so Korean Bitcoins are trading 50% higher at one point than American Bitcoins. And what's the deal there? Well, the deal is that the Korean won is what's called a restricted currency. And what that means is the Korean government, this is not specific to crypto. In general, the Korean government controls the Korean won. They do not want people to be freely trading it for foreign currencies. Um, and if you want to trade, if you want to sell your Korean won for dollars, you basically have to go to the government and say, here's my legit business reason for selling these won for dollars because I'm, a TV exporter or something like that. Um, and if you don't have one, they just don't let you do it. And crypto was not considered a legit reason. And so, yeah, you could buy a Bitcoin for, $10,000, send it to, Bithumb or Upbit, sell it for $15,000. But what you actually got was, not $15,000. It was, 15 million Korean won, and you can't get those out of the country. You can't turn those won into dollars and then get that out of Korea. The only thing you can do with that won is buy back really rich Bitcoins with it. Or as sort of the moniker came from, you can buy a whole lot of kimchi. So it's true that you could turn your Bitcoins into an enormous amount of kimchi in Korea if you wanted. But actually completing the arbitrage was extremely regulatorily difficult. And so because of that, there's sort of nothing preventing a Korean Bitcoin from trading at a big premium. And when we saw huge Korean buyers of Bitcoins, it just did.
Now, over time, the dominant stablecoin was Tether, but lately you have a rising number of other stablecoins. Like Kyle points out over on the TeamSpeak, he says thoughts on rising number of stablecoins like the OKEx, and Binance stablecoins. Do you think Tether's losing dominance? What is your experience on this?
Yeah, so far we haven't seen a huge hit to Tether dominance. It still is the vast majority of stablecoin usage. And I think what I would do is I'd split this up into two different categories. And the first is heavily institutional stablecoin usage. And there we have seen movement. There we've seen increasing numbers of institutions using things like USDC. But when you look at exchange or retail usage, it's still very heavily Tether based. And I think that's just because that's what they're used to. All the exchanges list Tether pairs. That's where the exchange liquidity is. And especially a lot of the Asian customers are used to Tether. That's what they're used to buying, especially with their RMB. And that's what the brokers, especially the cross-country currency dealers in Asia, are used to using. And so we haven't yet seen a huge switch from Tether to new stablecoins, despite how many there are. And I think looking at a lot of the different stablecoins, I think again the huge thing about them is, can you redeem them for dollar? If you can, they're basically interchangeable, and if you can't, they're a shit show. And we've seen some examples of each. And if you look at a stablecoin that's completely dying, there's a decent chance the reason is no one can provide liquidity in it because you can't redeem it for a dollar.
In cases in which the stablecoin has wildly disconnected from the redeemable price, have you taken the risk in getting in a nice little trade on it? Like, for example, when Tether goes really below $1, do you get a nice Tether position?
Yeah, we've put on some pretty big Tether positions. And I think we bought a lot of Tether at 90 cents last time it went there. And what this comes down to is, what exactly is a Tether? It's not exactly a dollar. It costs 1% to redeem. It depends on what size you're doing. It's not instant to redeem, but it is sort of basically redeemable. It's actually quite a pain banking-wise to redeem it. You need to have the right bank account basically to be able to do it, but it is possible. And sort of putting that all together, we spent a whole lot of time trying to understand exactly what a tether is, exactly how it works, and exactly what we think it's worth, so that we know, when it goes down to 90 cents, is it a great trade to buy it? Or should we be terrified that it's going to be at 50 cents next? And as it happens, when it went to 90 cents, we were pretty comfortable that this thing was worth at least 99 cents. And so we're pretty happy buying there.
User Hikinashi from TeamSpeak points out a nice question. He says, do you have any thoughts on China's state-backed stablecoin that is being reported as being developed?
Yeah, so I think that it's, obviously it could be a huge thing, but a lot of things get reported as being developed. And I think the big thing here is going to be like, does the Chinese government really lean into this? Do they make a big deal of it? Do they even complete development on it? And then if they do they start, using it for official government business? If they do, obviously that'll drive a huge amount of flow to it, and it could become a huge fixture in crypto. But you know, there's remember, China's not the only one who's announced this, right? JP Morgan's announced something, obviously Facebook did. Um, you hear large institution after large institution say something vague about, yeah, we're gonna make our own stable coin. And usually these at least haven't happened yet, with the exception of the crypto native institutions, which have by and large followed through on them. And so I think it's all going to depend on follow through here, whether they decide that for some reason they're going to prioritize this.
Now, moving on into the actual operations of Alameda, just how manual or how automated are the trades that happen on with you guys? Like, for example, how much slack would you give a trade? Do you have examples of trades that have worked in which the traders themselves saw the opportunity before the actual parameters you set in?
Yeah, we definitely do. And while most of our trading is done by automated systems, it's often with heavy manual input. And I think my favorite analogy for this is, like, we think of our bots as big dumb humans with lots of hands that can click really quickly, basically. It's not that and that can calculate really quickly. It's not that our systems are brilliant and see things we couldn't possibly imagine. They're just sort of doing what we say, but they can just work so much quicker than we can. And it's not just that they can do a trade quickly, it's that they can synthesize 200 sources of information do a computation on that, come out with some parameters, and then trade based on that on 30 markets at once in a way a human never could. And so, there's a lot of advantages to using them, but still most of the intuitions just come down to things that we've tried to teach our systems about, and we haven't taught them everything we know because that's really hard, right? You can imagine trying to teach a computer something that's really weird and some intuition you have, which is like hard to put into words even, and it's even harder to put into code. And so there are a lot of times when we're like, man, like I really think buying here is good. I don't think our systems are going to understand this. It's based on this sort of weird intuition that I just know we haven't found a way to express to them yet. And so what we'll do in that case is either we'll go by manually or we'll tweak some parameter in our system. And one of the parameters that we have is like basically a buy something parameter. And so what we can say is, yeah, bots, do exactly what you're going to do, except buy an extra 20 Bitcoins. And do that however you think is best. And so often we'll use toggles like that in order to express sort of manual intuitions that we don't think our systems are picking up on.
User Decky from the TeamSpeak is asking, is the auto trading done with custom software or easy to run scripts people can learn for themselves like PineScript?
It's all done with custom software. And the reason for this is basically, we've investigated using third-party systems a lot, and we always have the same conclusion in the end, which is, yeah, that was useful for a bit. But at some point, we're like, yeah, okay, but we want to make this change, but we don't own the code base for that thing, so we can't edit it. And so unless it literally is exactly what we want, eventually we're going to outgrow it. And we had this with FTX as well. We used to use Auth0 for two-factor authentication, and it meant that it was really quick to set up 2FA in the first place. But then we're like, oh, we want users to be able to like reset their 2FA code on their profile page, and Auth0 didn't have functionality for that. And we're just stuck. There's nothing we can do but rewrite it ourselves. And we sort of run into this time and time again. And so, over time, we've basically just, realized that this is all going to have to be basically custom built.
We have a question over from the Twitch. User, it's fucking wrecked. He says, does Sam think that Tether on Liquid will be the way forward, especially as the ETH mempool remains full and is only getting more full as ERC20 Tether is becoming more popular?
I don't have very strong feelings on what chain Tether is going to end up on. I think that with the recent Omni to ERC20 swap, and by swap, obviously they both existed the whole time, but with the recent change of where the bulk of the activity is, the community's kind of shown that they're pretty fine switching. And this could happen again. Yeah, it could switch to Liquid. It could switch to an EOS token, could switch to some new protocol that comes along. Maybe at some point Bitfinex will write their own blockchain and move Tether over to that. Maybe BNB Tether. Like, it's sort of not clear. And I think that just the cost of switching is so low that I wouldn't be shocked even to see it switch a few different times. And I think it's a bit hard to predict what's going to be the dominant chain for these things going forward, because other than saying maybe it'll still be ETH, because you look at something like Liquid, it could totally take over or it could just go nowhere, and both those are totally possible, because it's sort of, you get nothing from Liquid if it's on 20% of places. You have to both be able to send it to somewhere and from somewhere. And so until basically everywhere that you want to trade on supports something, it's really hard for that thing to take off.
Yeah, it's a classic example of needing proper network effects.
Exactly. It creates these really unstable equilibria where you have nothing, 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 then you hit some threshold and something takes off. And that just makes it super hard to predict whether or not that thing is actually going to take off.
Sam, quick question, going back to the exchanges and fake. Binance for a while has been accused of lots of fake volume, and sometimes it's just blatant fake volume, right? And considering that, and considering also they have had stuff like the quote-unquote API hacks, as user Jakey on TeamSpeak says, and if you also ask around a lot in private conversations, people will tell you about certain weird things that people have seen in Binance from now and then. Do you feel SAFU with your funds over there? And how do you separate the risk of having such large trading sizes with problems that could arise with these exchanges?
Yeah, it's a good question. And I think the first thing I'd say is like the world isn't binary. And some exchanges are very easily to classify in a binary sense. There are some exchanges that are just 99.999% fake. And they claim $3 billion of volume a day. In fact, they have $200,000. But a lot are somewhere in the middle, and most Chinese exchanges that have real volume do have some fake volume. I don't think that Binance themselves creates fake volume. Like, I don't think that they, some of these exchanges have an internal bot that prints fake trades, and Binance definitely doesn't do that. That being said, especially on the really illiquid coins, you definitely see some projects hiring some third-party team to basically self-trade in order to, pump up volumes. And so that definitely happens on Binance. It doesn't happen a lot. So it doesn't happen much on their most liquid pairs. It doesn't happen for huge size usually. And you know, as far as exchanges go outside of very regulated jurisdictions, Binance has relatively little fake volume. Um, that's not to say it has none. Like it definitely, like, none is not the right answer. But most of their volume is real. Um, and I think especially when you look at the old big Chinese exchanges, you have to have sort of a non-binary view of it. And rather than asking is their volume real, asking what fraction of their volume is real. And for Binance, I think that's going to be like, I don't know, 90%, 95%, something like that. So yeah, there's some wash trading. It's not done by Binance itself, and it's not most of their trading. To get to serve your second point about how safe do I feel? I think again, like something we've seen time and time again in crypto is that hot wallets sometimes get hacked. This happens. We've seen it from Bitfinex, Binance, Bithumb. It's probably happened to a lot of exchanges that we just never heard, right? Like if it happened to Coinbase, would we know? I don't actually know if we'd know. And I, in general, these get reimbursed. Like the pattern of hot wallet hacks is that the exchange eats them, and uh, you have to go back a long time to find a major exchange hack that did more damage than that, right? I mean, you basically have to go back to Mt. Gox to find a major exchange. The biggest exchange in recent memory that had more than just an exchange reimbursed hot wallet hack was Quadriga. And so I think what I'd say is, like, if you put your funds on any exchange, you have to think there's some chance that their hot wallet's going to get hacked. But most reputable exchanges don't keep more money in their hot wallet than they're willing to fund out of pocket. And as long as that's true, the users by and large don't bear many of the costs of that, other than maybe a week of withdrawals being down. And the thing that's much more worrying is if the exchange might lose all of their funds. But that's actually surprisingly rare for anything except for pretty minor exchanges in crypto.
User Decky on the TeamSpeak asks, "Can we talk about sizing, please? How do you go about sizing when you're trying to take a large position? Is there many components like multiple OTC, hidden orders, block trades, etc.? Talking about a truly big position."
Yeah, and I think I'd split that into two cases. Case one is we actively decide to take a big position, and case two is someone decides to dump a big position on us. And basically, one version of this is someone asks us for an OTC bid on 2,000 Bitcoins, right? And then we have to price into that. How hard is it going to be to get out of that position? Another version is we decide to put on a position. And for that, we're much more thinking like, how do you execute a big trade? And by and large, I'd say that there are two strategies. And which one you use depends on exactly what's on the books at the time. One is you can sort of slowly buy everywhere all at once, trying to minimize the impact. And basically just say, look, like, we're just going to sit passively trying to accumulate, basically. And that's often a good strategy if you have a lot of time. If you can, it's fine if it takes 10 hours to get this position. If you're like, I've got 2 minutes and I need to put on a big position, it's not clear that's going to work. And so instead, what you might do is look for big offers, right? If you want to get really long Bitcoin in the next 2 minutes, probably the easiest way to do it is to look at the exchanges that have lots of size displayed on the order books, find the biggest, and try and lift all those.
Now, this leads me to talk about that famous trade you guys pulled off on Binance, in which the huge wall came in. Now, talk to us about that particular trade. Were you looking to arbitrage?
Yeah, we were mostly doing arbitrage there. The biggest piece of that trade, for those who don't know, basically someone sold something like $80 million of Bitcoin on Binance in one big chunk. And the biggest thing that we were thinking about there basically was like, that's a lot of Bitcoin. First of all, we want to be able to buy it because it was sold at a pretty low price. But second of all, we need to make sure that we can actually hedge this, that we can actually sell these Bitcoin somewhere. And that, even if we're buying slightly below where the market is, maybe by the time we're done selling out of these Bitcoins, we'll have had so much impact that trade is bad. And so there's sort of two pieces of this. One was moving capital around to be able to do the trade. So moving Tether onto Binance to buy, and moving Bitcoins onto other exchanges to sell. And the other part of this was trying to get a sense of, okay, exactly how aggressive should we be buying this? How much below the market does it need to get before we feel like we can just buy these Bitcoins and we're going to be able to sell them and make a profit?
Now, considering your models, just how fast do you guys see your models going into obsolescence for the automated trading?
Yeah, it's a super good question, and some of them blink out of existence in a day, and others have been alive for 2 years. And the way I think about that is basically the ones that are pretty fundamental often stick around for longer, and the ones that are like, boy, someone's buying an enormous amount of Cardano on Huobi, like that's the sort of thing where like that might dominate Cardano trading for a week, and then that guy just has as much ADA as he needs, and he's done, and that model's useless now. And so, I basically what I'd say is like if something's just sort of a really fundamental, like even something like, man, this exchange seems pretty important. Like things like that tend to persist for a long time, but sort of really coin specific things often we'll just see a flash where it's an enormous amount of interest in some pair for a week and then it'll die down. And you saw the week where Litecoin traded at a 30% premium on Coinbase, trading billions of dollars a day. And now Litecoin doesn't trade on Coinbase almost at all. So that wasn't a fundamental, like, yeah, like obviously if you're pricing Litecoin, you got to be looking at the Coinbase market type thing. It was this specific week. There's this huge United States-based inflows into Litecoin, and this is the only liquid US exchange it was on at the time.
Sam, people often ask, and well, they also meme a lot about quant traders and firms. Like, usually on this space, we have the latest boogeyman, and the one that's going on right now is that the reason that a trade didn't work out is because a quant took my trade, they took my stops, Alameda took all my money. Now, for the real part though, how would people even start to follow the path of trading in like a quant trader?
Yeah, it's a good question, and maybe I'll just first start by saying like we don't hunt stops. Like that's not a real thing. That's your stops will trigger sometimes because prices moved, but it's that's not how we actually think about trading. To get to your point of how would you think about kind of getting involved in quant trading? It's hard. It's the public material on it is really crap. And the reason it's crap is if you publish a strategy publicly, it probably won't make money anymore. So by definition, sort of all the good strategies are not public, and that makes it really tough. And sort of the best thing I can say is practice having a lot of self-discipline, really holding yourself to a high standard, not taking it for granted that your trades are good, and making sure you're not cheating, that you're not like crediting yourself with your winners and trying to explain away your losers as bad luck. Combined with, to the extent that you can, partnering with some existing quant traders, whether it's an existing firm or something else like that, that sort of has a wealth of built up knowledge about this.
I mean, Sam, you say that people don't run stops, but in low liquidity areas and with such low regulations like in crypto, running stops happens.
So, and you certainly see a lot of stops triggering. It's a different thing to say that people like intentionally try to trigger them. And I'm sure that there are some people who do that. It's not going to be sort of the high profile quant firms by and large. Um, that's not sort of the profile of trading that they typically do for a number of reasons. One of which is that it's like uh, often not considered in compliance with major country regulations. And even if the exchanges aren't regulated, often the highest profile trading firms will feel themselves to have some duty to act within the spirit of what they think regulations would be were they to be applied to the space. Um, because often, they fall under some amount of scrutiny that isn't applied to the exchanges, especially if they have operations in regulated countries. And so it doesn't tend to be quant shops doing things like that. Um, and you know, the other thing that I'll say is like, even if it does happen sometimes, I think it's a pretty small fraction of the times that it's claimed. You sort of look on crypto Twitter and you see people constantly saying like, oh, things happen because of this or that, and like we don't usually know why things happen, but when we do know, it's like crypto Twitter's usually not correct. And most places are usually not correct. Usually the answer is like, well, there's a big seller. That's why things went down. Not like, oh, there's this really cool like stop hunter who had this complex strategy to blow out his arch nemesis. No, it's just some whale decided he wanted to buy a mansion, so he sold a lot of bitcoins.
Sam, how do you think the landscape has changed from when you started trading versus right now?
So it's become a lot more efficient. Is probably the biggest thing. Um, you can look at arbitrage spreads; they're a lot lower than they were 2 years ago. You can look at you can look at things like uh, insane market movements that are obviously going to revert. Those are a lot less. You can look at insane amounts of momentum that are obviously going to keep going. That sort of is a lot less prominent. And just sort of in general, like, uh, things have been tending more towards an efficient market. The infrastructure in the space is still pretty bad and still pretty underdeveloped relative to the rest of finance. It's still pretty hard to move funds around. It's still pretty hard to, to get accounts that have all the features you need. A lot of the APIs still aren't great, but the markets have gotten substantially more efficient.
No, Sam, when Alameda came in, part of the way they were so efficient in making money was that they found a way and they worked a lot about going about different jurisdictions and making sure the arts work, etc. And they extracted a lot of money from normal, like retail, smaller traders. Now, keeping this in mind, what's stopping other firms from doing the same thing and taking a piece of the pie from what Alameda is trading?
Well, first of all, I do expect more firms to come in, but there are some barriers to entry, and I think that like a lot of this is just work. We've put in an enormous amount of work to get to the point where we're at, and some of that is trading work, some of that is modeling, some of that's building systems. A lot of that is figuring out how the APIs of each exchange works. A lot of that is building relationships with the players in the spaces, especially the exchanges. A lot of that is building up a lot of knowledge about like, oh, well, when you trade this coin on this exchange, it has this weird property. And those things, they all just take a lot of time and energy. And we've put a lot of man hours into that, and we've been working really hard. And you'd sort of have to go through a lot of that process again if you wanted to compete with that.
Now, considering how successful you guys were doing on your trades, why do you even choose to venture into making a derivatives platform?
Yeah, it's a good question. And I think I'd say that there are sort of a few big reasons. The first is that we had a lot of experience trading on them. And so we sort of understood pretty deeply how they work. Um, the second is that they're extremely high upside businesses. You can look at the sort of valuations that the top ones are getting. They're very, very large. Um, and the third is that there's a lot of problems with them. People are not very happy with the current derivatives exchanges for a lot of reasons. You can sort of look at everything from like matching engine issues to hundreds of millions of dollars lost to clawbacks. to really annoying collateralization, to a lack of creativity around the product space, and just a general lack of innovation, where, sort of the big news is like, another identical copy of this old mediocre derivatives exchange is about to launch. And it just seemed like a space really ripe for innovation that also had, really high upside potential.
Now, this led you to create FTX. So, in your opinion, why do you think it's actually better than BitMEX, FinX, Bybit, OKEx, all of them?
Yeah, so I think that some of it is just fixing a lot of problems. So one of them is, mitigating clawbacks. We've never had any clawbacks on the site. We don't expect them, because, we've thought pretty hard about exactly how the risk control should work here. Um, Part of this is making the margin a lot simpler. You go on a lot of these platforms and you want to trade Ripple. Well, you want to trade Ripple futures, you need to move Ripple over. You want to then trade an ETH future, you got to move some ETH in. You want to trade a BSV future, you got to wait for your BSV to hit the exchange. And you want to go from trading one to trading the other. Well, you somehow got to deal with the fact that you now need a new sort of collateral, and that's just like a massive pain. So the first thing is we have one central collateral wallet. You can put any of dollars, Bitcoin, or Tether into it, or FTT, or exchange token. And then you can just go back and forth trading whichever features you want on the site. You never need to rebalance your collateral. If you want to, you can. You can use sub-accounts to isolate your margin, but by default, you don't have to. Another thing is we just listed futures on a lot of products that don't have futures, but that there's a lot of demand for. Exchange tokens are an obvious case of this, with BNB, Huobi token, OKB, and Leo futures. Another example of this is a Tether future if you want to gamble on the Tether premium or want to hedge your Tether exposure. And then the third thing I'll mention is the index future. So we have an altcoin future, a mid-cap future, and a shitcoin future. And what these are futures that expire to a basket of coins. And so if you want to hedge your exposure to altcoins in general, but not a specific one, you can just, sell, you can short the altcoin future. And if you want to, bet that BTC dominance is going to take a hit, you can get long, the altcoin mid-cap and shitcoin futures against short Bitcoin. And so it gives you a ton of flexibility to easily express, kind of macro sentiments about parts of crypto. And I think that's sort of another cool product that other exchanges don't have. Our matching engine doesn't have lag even during the busiest of times. Our API is straightforward and works with REST, WebSocket, and Fix. Our fee schedule is reasonable. And we just have a ton of tweaks. We do, instant withdrawals. You don't have to wait till the end of the day or anything. We'll pay out your P&L to you immediately. You don't have to wait a week to realize your P&L. And so we basically just try and do a ton of things to make it as easy and straightforward as possible for people to use while giving them, as wide variety as possible of products.
Now, Sam, people always claim that their latest exchange is gonna have no issues, no clawbacks, no problems. But once they get scaled in users and actual liquidity, actual volume, that all falls through the wayside, right?
So, that's certainly like, an issue that a lot of them have had. I will say, FTX, it's already trading a few $100 million a day. It's traded close to $1 billion once. There are no problems on that day. We've onboarded a bunch of users. We already have the most liquid order books in crypto. I'm looking at, our Bitcoin order book right now, and it's a BIP wide with 100 Bitcoins on both sides, more than 100 Bitcoins. In general, I think it's already been somewhat stress tested. It already has 10 times as many markets as any other derivatives exchange in crypto. And we have 2 different futures and 3 different spot markets for 15 different underlyings each. So, we've already put this under pretty heavy load. And, matching engine wise, I don't think the latency ever gets above like 200 milliseconds.
Well, this also comes in. You mentioned that you have nice liquidity, but this brings on the elephant in the room, right? Like, why would people even want to trade in your home turf, right? Because, say, you guys currently provide a lot of liquidity for your own exchange, right? But what if you just remove that? There's really a conflict of interest there, no?
So like right now, the interests are very much aligned. Right now, if you look at, what are sort of the incentives for Alameda, it's for FTX to do as well as possible. That's by far the dominant factor here. And so, really the incentive is to provide as good of a customer experience as we can and to bootstrap as much liquidity onto the exchange as possible. And, over time, we want to diversify that liquidity. We're working on it. We've signed something like 10 or so market making contracts in the last couple weeks with, with new firms. And we, expect some of those to be coming online. Um, and, hope that that will help diversify the liquidity a lot, because we do think that it's important for the long run growth of the exchange that it does have a diverse liquidity pool that isn't, too Alameda dominated. Um, but right now I would say it's a huge advantage. It helps solve the chicken and egg problem of you can't get volume without liquidity, and you can't get liquidity without volume. And yeah, again, like I totally understand the worries about conflict of interest. And I could talk a lot about like, yeah, there's Chinese walls between the two, blah blah blah. But I think that sort of the clearest thing to see from the outside is just that like the incentives are very much aligned.
Now, some things that people have been liking is the creativity in making some of these new products. And I mean, when the shitcoin index you guys put out on FTX came out, people were having a nice little laugh, but it's actually quite useful. So, how did you guys come about into making this more esoteric products that come about? Is there
Yeah.
actually
So
a sufficient market for this?
yeah. So I'd love to kind of claim creative credit for all of these, but the truth is a lot of what we did is we just copied what the rest of the world had done in the rest of the markets. You look at what are really popular products in the rest of finance. What you see, I mean, you see a lot of index futures, you see leveraged ETFs, you see futures on a lot of different products, not just like the most liquid company. Um, and you see USD based settlement with cross margin, and a lot of what it's that sort of developed over the years as what seems like one of the best ways of building these things. And a lot of what we did was we just looked at the things that seem to have a ton of success in the rest of finance, and thought about if there's a good reason they hadn't been adopted in crypto. And if there didn't seem like a really compelling one, then we just sort of ported it over.
From what I've been reading, you guys are also looking into, well, you're actually already designing a VIX style product for, I think it's Bitcoin, or is it just crypto volatility? Now, how is that going to work, given that crypto by itself is a given that it's going to be volatile, right?
Yeah, so we've gone through a bunch of iterations of this, and sort of the delay in launching has been us trying to figure out what product people most want. Um, and the reason is that options are really cool, but you look at the current options exchanges, and uh, you know there actually just isn't much volume in them. And so a lot of what we're thinking about is like, what would actually drive activity here? What do people really want? And what we sort of decided on is, first of all, the key thing about options is it's not that they're volatile, because as you said, crypto is already volatile. And margin trading is very volatile. The key thing that sort of volatility products let you do is they let you make a bet on something other than whether something's going to go up or down. No combination of futures or spot or margin trading will let you express anything about a token really other than which direction it's going to go in. But with options, you can do something like say, I don't know if Bitcoin's going up or down, but it's going to move a lot, right? You can say, I just think it's going to be a crazy week, and I don't know if I want to be long or short here, but like there's going to be big news and things are going to move a lot. Or you can say, I think things are just going to kind of stay where they are now. Um, and you could get long or short options or volatility in general to express those opinions. And so, uh, it's we're planning to launch our first products later this month. Um, and I think that rather than structuring our first products as sort of call and put options, which is something that's been tried a few times before in crypto, and just we haven't seen a lot of retail interest in it, we're probably going to structure the products more as a way to trade volatility itself. A way to, because I think that's what most retail, rather than thinking like, man, I really think that the like 7,800 strike call expiring next March should be worth like $180 at least. Like, that's a pretty weird to evaluate statement. I think sort of a much more intuitive thing is something like, I think Bitcoin's going to move like $300 tomorrow, or like I think Bitcoin's going to stay within a $20 range of where it is now. And so I think that the first suite of products that we're going to release, probably we'll just release the Bitcoin one first, then for a bunch of coins, I'm guessing we're going to at some point have some index of those you can sort of bet on crypto vol as a whole, are probably going to have a structure like that.
Now, there's an obvious, I think, well, at least in my opinion, there's an obvious possible conflict of interest, having a player that moves as much volume as you guys, and then having you owning also an exchange in which people could bet if the price is going to move or not. Like, what's to stop Alameda from just looking at, oh, everybody's betting on a move, on no move, so let's just dump a bunch here or pump a bunch here.
Yeah, so it's a good question, and I think I'll give a few answers to that, but the biggest thing that I'll say is, again, like, we're really thinking long term here. This isn't something we see as a short term play. If we want to do a short term play in crypto, we would not have launched an exchange. It's been an enormous amount of work. We've put, an enormous amount of sweat into building this out. And, uh, sort of taking a long run view, like, if things just always print against customers, it's going to be a shitty product and no one's going to like it. And that's going to kind of kill the product. And that's a really bad trade. It may look like a good trade short term, but long term, it's a terrible one. And so that's sort of the first thing I'll say. The second thing is that, uh, it's, there are, obviously people can be hedging in the other direction if they want. We do expect to see other sophisticated players getting on as well. And it's really expensive to do this as well. Like, even just looking at crypto exchange fees, are high enough that, like, just doing trades to move markets costs a lot. And which sort of reduces the practicality of it to some extent. But really, I think the central thing that I would say here is that, we don't want a lot of pissed off customers. That would just not be the right long-term decision for the business.
Sam, user AA from the Twitch is asking, considering Alameda-FTX knowledge and experience of stablecoins exchanges banking compatibility, do you have an interest in launching a stable-like product in the future?
We've thought about it a little bit. I don't, we might, but I would guess not. And the reason is that there's a few reasons, but basically, they're super important products in crypto. But the current ones are pretty good. Especially the best of them are just pretty good stable coins. They basically work, and we don't see a huge need to innovate over what they already have done. On the product side, from a business side, they don't make that much money. Sort of an interesting fact, but you can calculate out roughly how much exchanges make in crypto, and you can calculate out roughly how much stablecoins make, and it's not close. And the reason is, like, how does a stablecoin even make money? The only reason they make money is interest in bank accounts. Interest rates aren't very high. It's just not like a business that we're super excited to go into right now. And again, I think we'd do it if we felt really dissatisfied with the current options. But, like, we think a lot of them are pretty fine.
Sam, user Kyle from the TeamSpeak asks, are you co-located to any existing crypto exchanges? If not, do you have any plans?
So I'm guessing the U there is FTX. So FTX is currently hosted in AWS Tokyo. And so that is, co-located in the sort of crypto sense of it's in the same Amazon Web Service region as other things are. Although it looks like Hal's actually, got that wrong. Hal's asking about Alameda Research. The answer is actually kind of similar. Alameda Research is co-located in that it has boxes in a lot of AWS regions. And given that most exchanges are on AWS, that's sort of as good as you can do. We don't have physical colos. Although, again, given that most of these are cloud hosted, that wouldn't do much anyway.
Sam, would you mind talking over how the FTX insurance fund works and how it differs from the BitMEX insurance fund?
Yeah, so the actual insurance fund itself is pretty similar, in that, if there is a loss, the insurance fund will cover it before any customers would. I think the core difference in the kind of liquidation model is that before getting to the insurance fund, we have a backstop liquidity provider system. And what this means is that if there's an account that's getting liquidated, that we're worried is not going to get liquidated in time, and by we I mean some automated risk engine, um, and sort of the account is getting dangerously close to bankruptcy, rather than continuing to sell out of the position, crashing the market. We have basically a stable of liquidity providers standing by, ready to take on the position, and it'll just be passed off to them, and then it'll be sort of their duty to figure out how to work out of that exposure, whether it's on FTX or somewhere else. And so basically a bunch of people ready to catch accounts before they go bankrupt, so that we don't have to deal with, using the insurance fund in the first place in most cases.
This sounds a little similar to the current Kraken system they have of assignments for liquidations.
Yeah, that's right. I think they came out at about the same time. I mean, we certainly felt like we came out first and they copied us, but I suspect what actually happened was we're just both internally developing basically the same system independently at the same time.
I have a question here from user King Nick on the TeamSpeak. He says, is there a chance your team would add Alt-BTC pairs in the future? Like, for example, ETH, Alt, MIT, and shitcoins. I mean, it makes sense. Traditionally, altcoin traders like to focus on growing their Bitcoin stash, so they trade a lot of Bitcoin pairs on spot. Are you looking to doing that?
We are looking into it. We'd hoped to have done it by now. I apologize that we haven't. It's been delayed. The biggest reason is that we got into a lot of internal discussions about how to settle them. Settlement is currently USD based on FTX, but the natural way to settle Alt-BTC pairs is BTC based. And we have to sort of, no matter what decision we make, it's going to make something a little bit ugly. Either it's going to complicate the settlement system, or it's going to have some weird Quanto effect or inverted future or something like that. And none of them seem perfect to us. And so it's basically stalled on us deciding how to settle them. I still hope to have it out pretty soon. But at this point, I think we're probably looking at another month before they're actually live.
This makes sense because I remember you saying on another interview that the entire point of having a derivatives exchange is that people don't actually need to touch the actual asset.
Exactly. And now if we're telling people, yeah, you got to have both dollars and Bitcoin's collateral here, that just like increases the barrier to entry to using the product.
User Kronos on the TeamSpeak asked, can you tell us about the size members of the Alameda exchange team?
Yeah, so it's something like 10 on the Alameda side, 15 on the exchange side. And that's looking something like 5 trading, 5 developers, and 15 ops and business development.
Are you looking into options trading?
Well, we'll certainly be doing some options trading because FTX is launching options. I think that's probably going to be the first foray. Alameda has traded some crypto options before. It's not really our bread and butter. It's partially just because there isn't a ton of demand for it in crypto yet.
Jake, you've been getting a couple of questions because everybody always sees you either on Twitter or streaming or doing something. Do you work 7 days a week?
Yes, I do. I
On
generally take off something like 1 day a month.
Yeah, like right now it's what, like 2 a.m. in Hong Kong?
Yep, 3 a.m.
Uh, Sam, on FTX, is there a possibility of adding longer time frame futures contracts besides the traditional quarterly, like say 6 months or year-long contracts?
We could definitely do it. Wouldn't be that hard. It's we haven't had a ton of demand for it, which is why we haven't done it. So I don't think we're about to do it, but we probably should just send out a survey at some point asking how many people want them. At some point we do have to worry about matching engine load. And we're not near the breaking point, but adding a semesterly or yearly future would add, each one of those adds another 15, 20 trading pairs to the exchange. And those start adding up, and at some point it trades off against listing more spot markets. or listing more types of leverage tokens or something like that. But if there's a ton of demand for it, we'll definitely do it. So yeah, feel free to just like tweet at me if it's a thing you'd want, and maybe I'll send out a poll sometime soon just to gauge the amount of interest in, futures longer dated than the next couple quarterly expirations.
Oh, thanks, man. Now, Sam, question. It's pretty common that people start trading a lot in Bitcoin, right? At least in our case. And then we go into like altcoins, and when things aren't moving, we start trading anything that actually moves. So it's a pretty common occurrence that people start trying to trade more legacy products, but you have a lot of collateral on Bitcoin. Like, does FTX have any plans to add forex, traditional stocks, commodities?
Yes. We're still finishing up regulatory due diligence on this. And so I don't think they're going to be coming in the next week or anything, but I'm hoping in the next month or two that we're going to have launched our first products on something other than crypto.
Do you have any plans on accepting bank deposits directly, like say pounds, euros?
So you actually can already do US dollar wire transfers. And it's actually not super intuitive how to do it semi-intentionally, but you can do it through the OTC portal. So if you go to ftx.com and then click on OTC, you'll be taken to the OTC side. There's a minimum USD wire transfer size of $10,000. But if you do want to send a USD wire transfer of above that size, you can do it. And then there's a button to move those dollars between the OTC side and the exchange side. The reason that it's not built into the exchange is FTX does not have a bank account yet. And so that's done through liquidity providers, basically. We're working on getting actual fiat support for FTX, but we're also sort of cognizant of the regulatory hurdles involved in that as well. And it might come soon, but it might not. I'm not totally sure about that. I'm guessing once we do it, it's probably just going to be dollars to start out with. There's some chance that we just immediately get a ton of currencies, but my best guess is if we did that, most currencies other than USD would be slow and expensive, and that's sort of not a great product experience. So, to start off with, I'm guessing it's probably just going to be dollars. Although again, like if there's a ton of demand for GBP deposits, we could find some way of accepting them. It would just take some amount of work.
Sam, I don't know if you are aware, but there's an old meme in crypto about how over on OKEx, formerly OKCoin, if you had a big enough position, it was just basically a matter of time until you would get hunted. Do you ever worry about having a big position and having those exchanges just sort of conspiring against you?
Oh yeah. And I think something I'd say is like, I don't think we usually think about it in terms of them conspiring against us. I think that it's more that you don't even need that. Like, even if there's no conspiracy theory, if you have an exchange with a ton of volume and not much liquidity, it's just pretty easy to get sort of cascading failures of liquidity, like what we saw last year on OKEx futures, where they just crash 20% sometimes for no reason, because it would go down a little bit, then it would go down more, then people would start getting liquidated. That would cause it to go down more people would get liquidated, crash it down more, and it just spiral down. And so even if it was just random which way it moved at the start and there's no malicious intent, it's still pretty easy to see giant swings. And so I think that like because of this, we're pretty nervous. We don't put on big positions with huge leverage. If we have a big position on, we don't want to have 15x leverage on it, because then a 6% move can just happen and then we get liquidated. And so, we try and leave ourselves enough room that we'll have time to move collateral in before we would get liquidated.
This reminds me a bit about you have a video over on XTX official YouTube about why Bitcoin's price surges and plunges so fast. Can you talk a bit about that?
Yeah, so I think it's a combination of two things, and one of them is this effect of sort of cascading failures of liquidity, where it starts going in one direction, and then you just have this chain of liquidations causing liquidations that accelerates that movement. And I think we saw sort of a version of this late last year when Bitcoin plunged down to $4,000. The other thing that I'll say is that it's with something like stocks, like equities. If someone tries to crash Apple, at some point, Warren Buffett is just going to say, yeah, I'll literally buy half the company at a 50% discount. And yeah, sure, you're going to sell $1 billion of Apple, I'll buy $1 billion. You want to sell 10 billion, I'll buy 10 billion from you if you're actually giving it to me at half price. And I don't even need the stock to recover. I'll just sit there collecting dividends and I'll make money. But that doesn't work with Bitcoin. Like, Bitcoin isn't a dividend paying asset. Bitcoin is entirely dependent on market forces. And so because of that, even if there's no fundamental change in its use case, if it crashes 50%, it's like not completely obvious that it will recover.
Sam, user Decky over in TeamSpeak brings on an interesting point. There's all sorts of different derivatives events that people can trade on. Like, say for example, you could bet on a MakerDAO collapse, right? Are you looking into doing stuff like that?
Yeah, we are. And we're looking both into that and to non-crypto prediction markets. And again, we have to finish doing regulatory due diligence on some of this, and we have to make sure we'd have enough liquidity for these contracts. But we hope to start launching some prediction market type contracts certainly before the end of the year. Whether that's Trump 2020 prediction market or whether that's hash rate prediction, hash rate futures.
Now, I'm reading here that you guys are planning on doing a new product called Battle Royale. Can you tell us about what the specifics of it is?
Yeah, so this is a trading competition we're going to be running in October. We just launched the sort of landing page and signups for it. So if you go to ftx.com, you can click on Battle Royale and check it out. And there are a bunch of pieces to it, and I recommend people just read through it to understand all the details. But basically, it's going to be there are two pieces to it. From sort of the influencers or trader side. Basically, you can register to participate in it and, get your followers to kind of follow your account. There will be a leaderboard of P&L, and, you'll get prizes if you do well trading. In addition to this, spectators can stake FTT on sort of their favorite traders. And so if there's some, popular trader that you really like, you can so FTT is sort of the FTX exchange token. You can stake your FTT on them, and to be clear, this doesn't spend the FTT; you'll get it back at the end. And that's sort of your way of voting for them, or sort of throwing your hat in their ring. And then you will kind of get points as a spectator, dependent on how well the people you stake do. And that's that sort of creates a sort of mini game for the spectators, and also means that as a trader yourself or as an influencer, it's a great opportunity to kind of publicize this to your community, because you will also get rewarded based on the number of people who stake you.
Quick question back in talking about FTX. I just saw a question on Twitch by Whale Calls. Do you have is there a possibility of adding liquidations reporting to the API?
Yeah, that seems like a thing we should probably have. I will pass that on to our developers.
Decky says, hash rate futures is a real product needed for miner hedging. Have you thought about that?
Yes, we have, and we're hopefully going to launch them. I don't want to promise we will. I don't think that we have confirmed. I think one of the things we're most worried about is the liquidity for these, especially given that we might see nothing but sellers, or sorry, buyers, depending on which way we define it. And so we might see entirely one directional flow, and someone's gonna have to take the other side of that. But pending making sure that we're gonna get enough liquidity provided in these, it's a product we again hope to launch sometime this year.
Sam, we have user Robin on TeamSpeak. He asks us, what are your thoughts on large market moves like the recent 90K BTC move we had this week?
So, it's different moves look like different things. Sometimes obviously they're fundamentals driven moves, but not usually. As best we can tell, there are sort of three big types of things that seem to cause big moves. One of them is there's just a huge seller. And again, this is like there's some Bitcoin whale and he wants to buy 50 Lamborghinis. So he's going to sell all his Bitcoins, and that's going to drive Bitcoin down. Obviously, that's sort of a fake example, but in general, if there's some large holder of Bitcoin that wants to liquidate, or some large fund that wants to get into Bitcoin, that'll have a lot of impact. The second type of cause that I would point at is liquidations. Again, you start with a small move, but then it starts triggering some liquidations, and that causes more and more selling or more and more buying, and it goes in the momentum direction. And they can sort of spiral, each causing the next most levered account to get liquidated, turning a small move into a big one. And then the third thing is, I would say, things that look suspicious, things that look not organic, that look like someone was trying to cause a move. And we've seen increasing numbers of those in Bitcoin over the last few months. Things where it kind of feels like someone is trying to move Bitcoin's price up or down.
Okay, let's see. We have another question. I don't know if you remember, in 2018 there was a huge liquidation. Number one biggest position that was around $450 million position on OKEx. Did you trade that?
Oh yeah, that was a really weird day. So we did not sleep that day. So that was there are a few huge liquidations in OKEx Bitcoin contracts. And there are a lot of weird things that go into that. And just to point out some of those, one of them is that at some point buying them is really good, because at some point they've just are trading way below the rest of the market. But it's a little bit scary, and it's scary for a few reasons. The first is, you have to make sure that that you don't blow out before the market recovers. The second is you have to watch out for clawbacks. Those are often accompanied by $100 million of clawbacks from users. And you have to understand that you might lose a lot of the money you think you're making. Because those liquidations were not getting done before those accounts hit bankruptcy. Those accounts were very bankrupt. And the last thing that I would say there is, you had to sort of understand, is this the tip of the iceberg, or is this the end of the iceberg? Because it's not so great to really aggressively buy the tip of the iceberg of the selling. And those were sort of things that we were really thinking about when those were happening. Maybe one last thing they'll throw out there is, when this first happened, OKEx's price bands malfunctioned, and I think the Bitcoin contracts crashed like 40% of a Bitcoin or something like that, and just everyone who was long got liquidated. And then 10 hours later, they busted half the trades. And so, sort of understanding, we were sort of sitting there being like, boy, we don't know where our delta is. Maybe a lot of these trades get busted, maybe they don't. Are we really long? Are we not? I don't know. And that's sort of a scary place to be in.
Just a question by user Europe. What is the future of unified exchange order books? Is it even possible, and how would that work nowadays?
So I think that the next step that you're going to see is actually well-built smart routing systems. The current ones are kind of shit. But I think that you will see aggregators of liquidity popping up. The big hurdles to this are that having a shared order book between two exchanges only works if they have shared settlement. Right? The worry is that user on exchange 1 sells a Bitcoin to a user on exchange 2 through the shared order book. But now that user on exchange 2 needs to be able to withdraw this Bitcoin that was deposited to exchange 1. As you can't just share order books, you also have to share reserves and settlement, and that's a massive operational hurdle.
Sam, quick question. Let's be honest here. Is Arthur in control of the market?
Obviously, I can't say for sure, but I don't think so. It doesn't sort of read with how I think he operates. I mean, obviously he was in a jungle for the last month. I don't think he was pulling out his smartphone from sitting atop a tree, pressing down. So
It's a good
but
meme.
more more generally, I think that's sort of not obviously I think there are a lot of issues with BitMEX right now. I think especially when you look at their matching engine, lack of sort of new products rolling out, and a lot of things like that. I don't generally think that BitMEX themselves manipulate the market. Now, that's not to say that orders on BitMEX don't manipulate the market. I do think that there are third-party traders on BitMEX who are sort of doing shady things, but I don't think it's BitMEX itself.
Sam, you mentioned that the crypto and Bitcoin infrastructure itself is still really lagging behind what the possibilities are. Do you guys consider helping and funding a Bitcoin core development? Do you guys run your own nodes? Have you played around with Lightning?
So I think that like our expertise here is not going to be in the blockchain side of the settlement. It's going to be in the rest of it. It's going to be in the settlement infrastructure and the trading infrastructure. And so I think that's really what we're sort of focusing on here. Another thing that I think I'd say is that we tried for a while to give a lot of advice. This seemed to not be super effective. It definitely got heard in some places, but it sort of fell on deaf ears a lot, and that made us shift, pretty substantially towards just saying, "Fuck it, we're going to build this ourselves," and that's a lot of what FTX is. We sort of gave up on other people fixing these problems and just decided we can just do this better ourselves.
Sam, what is your macro outlook for Bitcoin price in your opinion? You think all-time highs?
So, the first thing I'll say is, I don't think that I'm the world's expert on this. But to the extent that I do have an opinion, I think that like a lot of this is going to depend on fundamentals. I think that sort of the world of hopium driving prices is slowly dying, and we're going to be moving to the new world where pricing, at least in a long-term perspective, is based to a decent extent on actual like uses and economics and fundamentals. And so what I sort of expect is that like, a lot of this is going to depend on like, does Bitcoin start getting a lot of adoption? Is there a lot of institutional buy into Bitcoin, or does it just sort of wither away? Do people generally just sort of lose interest? It never picks on, takes off anywhere. And I think that you could see a massive rally in Bitcoin if you have a ton of new use cases, a ton of institutional adoption. But I do think that's an if, not a when.
Sam, quick question. Sorry, my mic wasn't working. Sam, what was your worst experience trading Bitcoin?
It's my worst experience trading Bitcoin. I think probably like I'll give a few. Clawbacks are not fun. I think Alameda had $20 million clawed back or something in 2018. That was not we're not happy about that. We sort of feel like if we sell something for $11,000 and buy it back at $10,000, we should have made $1,000. And it's not just that you make less on that trade; you can actually lose because maybe you hedged it, right? You sell at $11,000, buy at 10,000. Somewhere else, you're buying at 10,500 and selling it at 10,000. So you think you made $500, but if 2/3 of your positive P&L gets clawed back, you actually lost money. So that's one thing I'll mention. Maybe another thing that I'll mention is having exchanges lock up our funds for long periods of time and not tell us why. That's never pleasant. I don't get angry much. I tend to think that like it's not super productive, but I've gotten pretty pissed at some exchanges when they have veered dangerously close to just stealing our money. And the last thing that I'll mention is in the early days we fucked up some transfers, and that was also expensive and sort of led to us spending a lot of time building out a really comprehensive transfer tracking system to make sure that we never lost track of coins halfway from one exchange to another.
Sam, feel free to name and shame which exchanges left you out to dry.
Oh boy. So so there is one which I know I've written about a few times before, which is we've had a lot of trouble with HitBTC, and I know we're not the only ones. In terms of like withdrawals getting processed on the month time scale. And we can only speculate as to why. We don't know for sure. We're a little bit suspicious. But especially Tether, getting Tether out of HitBTC is often quite the challenge. And eventually we just pulled out of trading on it because even though there are some pretty good trades to do there, it was not worth the possibility of losing the funds.
Now, on the flip side, which exchanges have been the best to deal with, in your opinion?
I will mention, by the way, just reading the chat here, we're definitely not the only ones who had HitBTC problems. Which ones have been the best? I think that like a lot of exchanges have gotten their shit together over the last year, and so this list looks different than 2 years ago. I think I'll name Coinbase in particular, one which was actually a huge pain to use 2 years ago, and now is like a super functional exchange. It has a pretty simple product base, like it doesn't have margin or futures or anything, but for what it has, which is a Bitcoin USD order book, it does a pretty good job. I think in general, I would say most of the top exchanges we've had relatively good experiences with. If you look at Huobi, OKEx, Binance, Coinbase, Bitfinex, BitMEX, by and large, they work mostly as advertised. Sometimes it takes a lot of work to get a good setup there, especially if you're using an API. And a lot of them have obvious problems. So I'm not saying that like their problems aren't real. I guess what I'm saying is that like their problems are often pretty obvious, and sort of getting beyond their failings, they have been pretty reasonable to work with. And yeah, I think like in general, we found a lot of the top exchanges to be pretty reasonable, and we've had more problems with the smaller exchanges where often we can't even get in contact with anyone there when we have a problem.
I saw in a different interview you mentioned that sometimes you even just resorted to going into WeChat and getting to people to
Oh yeah.
pay attention to you.
When we have millions of WeChat groups with a lot of different exchanges, because especially when you're dealing with Chinese exchanges, most other chat apps are banned in China. So that's where you're going to find people. And sort of more generally, like, we definitely like have put a lot of work sometimes into tracking down employees of exchanges, especially when they're not processing withdrawal bars. That's sort of the typical case, or we need higher limits or something like that. Often filing a support ticket doesn't get you anywhere.
Sam, tell us the truth. Are you back holding any ICOs?
We don't tend to trade things that aren't listed on exchanges. I guess there's one we are obviously bag holding, which is our own. We have a lot of FTT. But outside of that, we don't tend to do ICO investments. That might change. I think on the 6-month timescale, we're considering whether we should get more into the investment business, but it hasn't historically been something we've done.
But you did post Leo products pretty fast, though.
Yeah. So I guess I won't officially confirm or deny that, but we've definitely use Bitfinex a lot. Really appreciate their product. Obviously, Leo is a useful thing to have some of if you're if you're trading on Bitfinex. So,
Sam, would you like to talk anything else about your product battle royale that's coming out?
I think like there's a lot of pieces to it, and really I do just recommend you go to ftx.com, click on Battle Royale on the top, and check out. I think that the biggest thing I'll say is just like I was not involved in sort of the graphic design or content production for it. I was just sort of consulted at a high level, and sort of other members of the team who were doing the nuts and bolts. And I'm super happy with how it turned out. It just looks really cool. And I really encourage people to play around with it. Try signing up, try staking people, check out the rules. It just, I don't know, I'm really happy with, with what my team did there. And I think it's super cool, and I'm really excited to see what happens, come October. And yeah, I think right now, super happy to have everyone signing up, and super happy to have especially well-known traders signing up and promoting this to their followers. Again, you can get big prizes if based on how many people stake you and how well you do. So,
Sam, quick question. Back to the Tether things. It's one of the fundamental things that you use in your strategies to arbitrage and trade. Do you not get bothered by the recent New York investigation?
Everything's a matter of degrees, and I think it was an update. I don't think it was a huge one. I don't think it was shocking. I think it's something that's long been known, is that this is an area that Bitfinex and Tether and likely a lot of other companies in crypto had cut it close with, and that this is a possibility. Obviously it led to a lot of Tether FUD. I think that a lot of what we look at is peeling beyond the FUD. What's the real impact here? Does this shut down Tether or does it not? And in the end, it made it a bigger pain to create or redeem it, but it didn't really shut it down.
Sam User Zero asks, what are your thoughts on the BFX derivatives launch? So far, very little liquidity and volume.
Yeah, I mean, I think it's a reasonable product. I think it's similar to a lot of other futures products, and I think we'll see. I think Bitfinex has a good team, and I could definitely see them, building out a super awesome product. My guess is that it's not going to become a huge deal in crypto if it's just going to be like a Bitcoin and ETH against Tether perpetual future, just because it's not different enough from the existing products. But I do think the team has the chops to make a pretty cool product there, and I'm excited to see them keep innovating on it.
Okay, we've been running for an hour and a half. Sam, is there anything else that you would like to tell us?
I think I'll end this by the same way on most things, which is saying we'd be super grateful if you guys checked out FTX, and we really want to hear your feedback. We want to see you guys test out the platform, and you can find me on Twitter. You can find our Telegram group, our WeChat group, support tickets, however you want. Tell us what would make this the perfect platform for you, because that's what we want it to be. And if it's not, we want to fix that. And obviously we have a big stack and we can't promise we'll get to everything immediately, but we're trying to do as much as we can. And, we're pretty happy with the product. And, we're not asking for undying loyalty, but, we'd be really appreciative if you gave it a shot.
Thank you for being here, Sam. We'll give it a shot. We'll check it out. We really appreciate your time. We know you're a really busy man, and especially at the hour that we had you coming over here, it's like what, 3 a.m., 4 a.m. already.
Yep. Well, thank you for having me.
Oh, it's been great, man. I hope you can come in and just hang out informally. Like we have some people from other exchanges that when they are on their downtime, they just come in and hang out and just shoot the shit, you know.
I'll keep it open, and I'll pop in now and then.
Okay, thanks. Well, everybody, thanks for joining in and listening into this conversation with Alameda Sam. Hope everyone enjoyed it, and we're gonna have this right now. We're gonna keep it on the Twitch, on my Twitch, until we get back all the credentials and post it over on YouTube after it's finished. So thank everybody, and goodbye. Good luck.
See you guys.